Well, welcome to Target Professional Consults. Today, we are going to look at the compound instruments, that is, on the financial instruments. Good. Now, with the compound instruments, we're going to talk about the debt instruments or the convertible instruments. Please, if you have not subscribed, kindly subscribe to the channel and turn on the notification button. Good. Before we look at this, there are some few issues that we have to look at for before we go on to the compound instruments. So now let's look at it. First, we are looking at the financial instrument. The financial instrument. Good. Now, IAS 32 makes it clear that certain items are not financial instruments. So let's look at them first. The following items are not financial instruments. So in accordance of IAS 32, IAS 32, so the following items are not limited capital, are not financial instruments. Financial instruments. Good. So specifically, there are some items that are not financial instruments. We are going to look at them one after the other. The very first item on the list is physical assets. So let's look at physical assets. Physical assets. Good. Physical assets. Examples of physical assets are inventory, PP, PPs. Good. Okay. Can maintain PP. Then we can also talk about intangible assets. Intangible assets. So these are not financial instruments. Now we should know why I just do state specifically that physical assets are not what financial instruments. Now let's see. Now when you talk about financial instruments, it's an instrument that give rights rights of receiving cash to one party, maybe party A, and also impose a liability on the other party. So let's say party B impose liability on the other party. So basically, that is the financial instrument. Now, or it can also impose equity on the other party. Good. Now, with physical assets, with the physical assets, it gives you the opportunity or it creates an opportunity for you to receive future economic benefits or cash flows. It does not give rise to a present right to receive cash. So we are saying that all these assets, even though they create opportunity or avenue for you to receive cash, this asset does not give rise to a present, I will give rise to a present right to receive cash. So as a result of this, physical assets are not financial instruments. You cannot be classified as financial instruments. Why? They only create opportunity for you to receive cash, but that cash is not present right. As in, it does not, so long as you have an asset, that means you can receive cash. That does not mean that. Let's take it again. Here we are saying that if you do have BP or even free, this does not suggest that you are going to receive cash instantly. No, but there's possibility. But here we are looking for a contractual right that allows you to receive cash. So here there's no contractual right that allows you to receive cash, but instead it creates opportunity. Yes, possible opportunity or probable opportunity. Good. Great. Now let's look at the second section. The second type of item that do not form part of the financial instrument or that must not be classified as financial instrument is the prepaid expenses. Prepaid expenses. Good. Prepaid expenses and what? Deferred revenue. So deferred revenue, and warranty provision. So warranty provision or obligations. So warranty provisions or obligations. Now let's explain why these items are not what are not supposed to be classified as what financial instruments according to the IAS 32. Good. Now the issue is this: the prepaid expenses, that's the future economic benefit, is the receipt of goods or services. Yes. So if I pay for expenses ahead of time, it does not give you right to receive cash flow, but rather it gives you the right to receive goods and services. That is it. So prepaid expenses does not give rise to receive cash, basically. So if you have paid electricity ahead of time, maybe next year electricity bill, the whole year or the entire year has been paid upfront, it will only allow you to enjoy free service when you get to next year. It does not what gives you right to receive cash. No, so that's the prepaid expenses. So these are not financial instruments. Good. Now let's look at the third one. The third section, we will talk about assets and liabilities that are not contractual. Good. So contractual. So assets and liabilities that are not what contractual. Good. That is contractual in nature. Now, if that asset or liability is not as a result of contract, it does not impose a strict liability on you, or it does not give you a present right to receive cash. So as a result of this, it does not impose any obligation. No, there's no liability because there's no contract. So if there's any asset where there's no a valid contract, it does not impose payment on any party. Good. Good. So as a result of that, we cannot classify such transaction or such assets or liability as what? As the financial instrument. Good. Now let's go to the main section of the game, that is compound instrument. Compound instrument. So here we look at compound instrument. Compound instrument. Great. Now with the compound instruments, let's see. We said that financial instruments will be like this: assets, the transaction, a single transaction or a single contract, which gives right to party A. Let's make it party A and party B. So good. So in one transaction, transaction one, it can be financial asset to party A and financial liability, vice versa. Good. Transaction two can be financial asset to party A and financial equity. That's equity instruments. Good. Now look at the third one. Look at the third one carefully. Good. Now the third one is a financial asset to A, but it is both financial liability and financial equity to B. This is a typical example of compound instruments. So the compound instrument is a financial asset to one party and presents financial liability and financial equity to the other party. That is a compound instrument. The most common form of compound instruments are compound or debts, convertible debts, good. Then convertible or cumulative preference shares. These are the most common form of compound instruments. Now the common example is the convertible debts. These are the examples of the compound instruments. It's one of the common example of compound instruments. Now the issue is because it gives equity and liabilities at the same time, IS 32 specifically require a separate word classification. So you have to find the equity components, classify it on its own, and look for the liability component and classify it on its own. That is the classification. So it normally creates a challenge for us. So when you get an instrument, we have to break into two: equity component or equity option and the liability component. We are done. Good. Now we'll go through some few steps on how to separate these values. Good. So first, to get these components, first prepare these components. Find the present value of all the cash flows associated with the debts. So to determine the components of compound instruments. In the compound instruments, let's make the steps straightforward. Step 1, determine the liability option or the liability components. That's the first step. First, determine the liability component. So that's the first item. So determine the liability component. Good. 0. Now deduct the liability component from the proceeds. So determine the liability component, then 2, deduct the liability component from the proceeds of the compound instruments. These are the 2 steps to separate the liability section from that of the equity section. So the answer is what we term as the equity component. So this is the equity component. This is the liability section. How do you get the liability section? Find the present value of all the cash flows associated with the instrument. Is the PV of the cash flows. Now the cash flows are all the interest, that's the finance cost, plus the principal. We are that basically. Good. So now let's write 9 is that last section here for us to go through and read these 2 steps to operate for it and we are done. So, let's write a example here. For example, Target PLC. Target PLC issued 10% convertible bond. Convertible bonds of Ghana cedi of 50 million for 48 million. 48 million with a transaction cost of 2 million. Good. Transaction cost of 2 million. 2 million. Good. The bond reading at par. The bond will be redeemed at par in 3 years time. In 3 years, giving an effective cost of capital or effective rate of 15%, giving an effective rate of 15%. So giving effective or in short, but in short, system effective interest rate is 15%. Stop. We are done. So a bit straightforward. Required. Account for the above in the books of Target PLC for the relevant years, that's the 3-year period. Show how the transaction will be accounted for. Good. Show how the transaction will be accounted for. Good. So first, we have to prepare the extract, relevant extract. But before that, we have to do the workings and separate these convertible bonds into equity component and liability component. So first, to get an equity component, 2 steps. Let's write here that we look for the equity component. For the equity component. Now let's see. We will create year and a cash flow and a discount factor. Use the coupon rate of 10% to estimate the cash flows and use the effective rate to discount the cash flows. That's all. Wait. Now let's see. So year 1, year 2, and year 3. What are the cash flows? The cash flows are the interest that we are going to pay. That is the interest. The interest payments are the cash flows. Good. Now, the interest will be 10% on the face value times the 50,000. Let's read 3 zeros here. So here will be the PV. So in 3 zeros. So 10% of 50,000 gives us 5,000. 5,000. Now when you go to the last year, the last year will be 5,000 plus the principal. What is the principal amount? That is 50,000. That is the principal amount. Putting these two together, we have 55,000. Good. So this becomes cash flow. Now let's calculate the discount factor. Now the discount factor will be first year 1 is year 1 out of 1.15 the power 1. Good. And now give us 0.870. You can check it. If you go to your key, put key here, what will be the answer? Great. I like that. And the answer is what? 0.756. Good. Basically, that is it. Then finally, I go to your key, I'll put here, and then what will be the answer? And then the answer will be 0.652. Basically. So that is, now let's find the present value. If you multiply 5,000 by 0.870, what should be the answer? That is fixed. The answer will be 4350. 4350. What will be the answer? That's 5,050.756. Now give us 3780. Now 55,000. We had a 55,000 by adding the cash flow or the interest plus the principal. So times the discount factor. We said we use the effective interest rate, but we use the coupon rate or the nominal rate discount for it to estimate the cash flow. If multiplied by this, the 36,000 what we do is putting all this together, we get 4350 plus 3780 plus 36190. That's 44,320. 44,320. Good. Now this answer is a liability component. That is a present value of the liability at the inception of the year. So that liability option, the liability component. Then we compare this answer to the total proceeds. Now let's calculate the proceeds. The proceeds is coming from the previous picture. To get a proceed, we said that bring the face value if there's any discount. Now, the bonds were issued for 48 million. Meanwhile, the face value is what? 50 million. So, it suggests that there's a discount of 2 million. That's a what? A discount of 2 million. So, to get a proceed, you start as the amount, right, or amount received, which is what? Which is 48,000. Now let's what? The transaction cost. The transaction cost of 2 million, now 2,000. Take it off, get something like 46,000. So that's the proceeds. Great. Now you can also start from the 50 million, less discount of 2, less transaction cost of 2, giving you 46 million. It's also the same. Agreed. Good. So now we know that the proceed is what? 46,000. Let's go to the board. Let's go to the board. So the proceed the difference between these two the equity component. In fact, the equity component is the residual, the balance left. So let's quickly cover the difference. So this plus 46,000, 1,680. So equity component is bracket the balancing figure. It is 1,630. That is the equity component. Now we are done by splitting it into two. Then how would the financial statement look like? Good. Now the equity component will be classified under equity. Then we will proceed to account for the liability section. Let's account for the liability section. Let us account for the liability section. Yes, we have to prepare what we call the amortization schedule. Okay. Here, amortization. Schedule. We bring our year. Such year. Liability as such. Then with the financial liability, this section we now carry the financial liability measurement basis. It must measure both amortized cost unless otherwise stated. Then we'll bring the effective interest rate. Effective interest rate is 15%. And then the nominal rate is 10%. And then the balance carried on. So basically, this will be the entries year 1, year 2, finally year 3. So basically, this is what we're going to do. Now let's see. Year 1, year 2, year 3. What the liability at the start of the year? 44,320. Now you calculate the effective interest rate on the open balance. So 44,320 times 0.15. That's 6,648. 6,648. Then the nominal rate or the nominal interest for the coupon rate 10% will be valid on the 50,000. So the 50,000 and the 10% that will give us 5,000. Then put it on. That is the cash flow. That's the interest in. Then the difference between the effective interest rate and the nominal value is called amortized cost. So the difference between these two is called amortized cost. So the amortized cost is 6,648 less 5,000. Great. So let's see. So income plus 5,000. That's 1,648. Now plus 44,320. That's 45,968. 9, which is we still find a 15% on our value. So times 15%, so 0.15. Good. So this times the 15%, we have 6,895. Here will be 5,000 capital. Then finally, you have, so less 5,000, that's amortized cost. The amortized cost is 1,895. That is the amortized cost. Now plus the opening balance of 45, 6, 8, 45, 9, 6, 8, 5, 9, 6, 8. So 47, 8, 6, 3, 7, 8, 6, 3, I will add a second figure to it. So times 0.15, that will give us 71799. And we add these two, that's of 4, 7, 8, 8, 6, 3, 8, 6, 3. So you add, that will be 8, 6, 3. Perfect. Then you get something like 50, 55,042. Whatever you get, put all in the bracket. So here will be 55,042. That will divide the 55,042 and it will be transferred. So we are done. So in your financial statement, this goes to the financial position. The closing balances go to the financial position, and then the effective interest rate goes to the finance cost, goes to the finance cost. So let's now move to the finance costs. Good. So we issued with the finance cost to us. That's good. Then the equity component moves to the financial position. That's the equity section. That's very good. Good. So that's the end of the financial instrument. Kindly join us when you're solving questions. Good. If you have not subscribed, kindly subscribe to the page. That's great. So join us when you're solving the questions. Goodbye.